Welcome to this little video about what a business case is and how to put together a business case. My name is Professor Randrup, and I've had the pleasure to be involved in developing and approving business cases for about 25 years. And I'm also teaching how to do business cases in different universities. Now, the first thing to understand about development of a business case is what a business case is. It's pretty easy to explain because a business case is normally what we also call a cost-benefit analysis. So benefits would be benefits that an initiative or project will deliver. Cost is, of course, the cost that's associated with an initiative, and then what we try to do is evaluate benefits versus cost, and that is called a value estimation. Now, let's take a look at cost. So what cost are we actually talking about? Well, first of all, we have to separate out cost in what we call financial and non-financial costs. So if you're doing something that you think would benefit an organization or a business, the first thing you would do is try to figure out how much does it cost you in terms of financial cost. That can be out-of-pocket cost. So if you run a project, if you're bringing in consultants, if you're buying machines, or other kinds of things, that would be included in the financial cost estimation. The typical types we have, you can see on this little chart. So we are talking about external costs where we buy something. It could be employee time. So if we set an employee to work 3 months on a project, that incurs a cost for that employee for that length of time. We can also incur financial cost in terms of purchases of machines or renting machines, equipment, can be in capital cost. For instance, inventory increases will cost us capital if our proposal increases the inventory size. It can also be cost in terms of taxes, fees, penalty, and discounts we have to give for the initiative to be implemented. On top of the financial cost, there are also typically a set of non-financial costs involved. That can include a risk that we're taking, could be dissatisfaction for employees, could be dissatisfaction for customers. It could be general loss of competitiveness versus our major competitors that might eventually lead to a decrease in market share. It can be employee churn. Churn means employees leaving us prematurely. Could be pollution, could be image loss, or other elements. Now, if we look at the benefits, we also have the same types of benefits, either financial benefits or non-financial benefits. The typically financial benefits for an initiative would be relating to the income and operations. So that could be increase in revenue, could be profit increase, it could be increase in discounts, incentives, subsidies, or it can be savings in terms of taxes and fees, or if people are paying us taxes and fees, it could be in the increase in taxes and fees. Also, financial benefits could involve the assets related value. So that means that if we do something that makes an asset we have more valuable, an increase in value, that will also be recognized as financial benefits. So that could be if our inventory increases in value, if machines or real estate increase in value, those elements would be involved in asset valuation. It could also be that we increase the intangible assets we have. So that could be the brand value or in the intellectual property rights. If they are associated with a financial price tag, it can be asset deductions and amortization. So if we increase deductions and amortizations of an asset, typically that flows to the income statement that increases the bottom line profit. Could also be debt and dividends, could be valuations of the company or the stock price. Those would be recognized as financial assets values. We also have a set of non-financial benefits for different initiatives. It could be that an initiative increases customer satisfaction, decreases process time, increases the organization's or key people's competence levels, improves our systems, IT systems, improve our control over what happens. It could also enhance our corporate image or brand value, brand image. Those would typically be examples of non-financial benefits. Now, the value is then the last step that we need to evaluate. So what are value estimation? Well, basically, it is relating benefits to cost. How can that be done? Well, if you only look at the financials for a moment, relating financial benefits, financial costs would actually be evaluated by a profit evaluation. Could also be that instead of the profits, we look at a discounted cash flow. We can look at a return on investment. Return means the profit over the cost. We can look at a net present value, and we can look at an internal rate of return. There's a few other ones, but those are the standard financial value estimations of the net value of the proposal or the initiative. Now, there are also non-financial value estimations. That would include, for instance, assessing the list of benefits against the cost, especially if the benefits we're looking at are non-financials and the costs are, we couldn't evaluate them directly on a financial basis. It has to be an estimation or an assessment whether the benefits, the immaterial or non-financial benefits are higher than the tangible or financial cost. Could also be through a cost-benefit score or a value index. In all of these non-financial value assessments will be involved some kind of subjectivity in terms of estimating the relationship with benefits and cost. In non-financial value assessment, we're basically comparing apples and pears, and that is why an assessment is needed. In terms of financial valuation, this is where we compare apples and apples. So if one apple is larger than the other, then we know which one is the better one. In most situations in businesses, when we talk about a business case, we are talking about a financial business case. So in this little video, we will focus on the financial business cases and how they're put together. So let's take a look at an example. One company has decided to try to improve their sales and profitability through a direct mail campaign. Now, when we look at what benefits a direct mail campaign would generate, we typically talk about that this campaign is put into effect to increase the revenue. But how do we get to a number for the revenue for a direct mail campaign? There's a number of different ways to do it, but this is one of them. So first of all, a company looks at the number of brochures or direct mails sent out to customers. And that, let's say, for instance, we are sending out 1,000 different direct mail brochures. Now, out of those 1,000, not all people will respond. So we will expect maybe 5% to go in on the web page or to call the company in order to inquire more about products. Out of the 1,000, we then have a 50% that is responding. And out of the ones that are responding, let's say that 50% will end up buying something. In this case, that means that the expected conversion rate is about 25 out of 1,000 people. Now, depending on the value of what an average person that converts or buys something, they pay, we will then get a revenue. So in this case, you can see here, we have estimated that 25 customers will buy something, and the incremental revenue from those purchases, we've estimated to be 1,250. And that means in essence that every customer purchase for $50 each. Now, let's look at the cost side. So on the cost side, well, when we do the mailing, it costs something to do the mailing and send things out. In this case, it's been estimated at a cost of $550. And when people buy a product, then it costs us something in order to produce those and deliver those products. And that's estimated to be $20 per purchase, which is $550 for the 25 purchases. And that is why we have a cost estimate of $1,050. Then in order to evaluate the value, you can see here that the profit becomes $200, meaning the increase in revenue versus the increase in cost. That gives us $200. So $200 is the profit that's generated, or in this case, it could also be called the cash flow. Now, One way to evaluate the value is in dollars. It could also be in percent of the investment. So another typical value measurement would be the return on investment, ROI. In this case, the ROI is the profit, so that's $200 over the cost, which is $1,050. That gives us a 19% return on investment. We've already looked at a simple financial business case, but with larger investments, the simple method is not appropriate. So let's take a look at a more advanced version of a business case. In this situation, a company has been looking at how they are producing different products in one of their factories. They have been using leased equipment, and the machine they have been leasing is not very appropriate for the job done, and an engineer has proposed to actually buy a new machine and install it, and they are now trying to do the business case for this initiative. Now, what you see here is their business case. So in terms of estimating the benefits of changing to a new machine, they're looking at savings on the leased equipment, that is savings on the equipment they're using right now. We can see here that in 2017, the savings would be $3,000. That is equal to the lease payments, including everything. It's the same thing for 2018, and then the leasing cost decreases in 2019 and 2020. We can also see savings in labor cost. This is savings in terms of man hours spent versus the cost per man hour. In this case, you can see in 2017, where the change is planned to happen, there will be no savings in labor cost, but once the machine is up and running for a full year, we can see that the savings in labor cost is estimated to $7,800 for the coming 3 years. That gives a total savings in 2017 on $33,400. Now, because of the cash flow comes in over a number of years, one of the things we do if we evaluate a future stream of income is to deduct the inflation that is occurring every single year. So we do what's called a net present value calculation. In this case, we've been using a 2% inflation score, which is the target for many countries in this point in time. If we deduct the inflation rates from the cash flow, you can see here that the net savings, so the net cash flow in today's currency is $32,220. If we look at the cost of the initiative, we have the new equipment purchase. We have the installation cost. All of them has occurred in the first year, 2017. And then there's a maintenance fee running over the different years. And then what we have here is cost of value of cash. So for instance, if we need to use a capital in 2017, using that money costs money. So you can't just get money for free without interest. So you've got to pay for it. In this case, the payment rate for the cash is at 6%. So that's why we have a cost in year 2017. However, in 2018, we have savings coming in, and that is higher than the cost. So that's why the cost is actually a value of $603 in 2018 and so forth for 2019 and 2020. Now, the overall cost of cash for these 4 years is $549. Now, in this case, we then, when we aggregate these cost drivers, we also get a total cost. You can see that for each year here. And again, when we do a net present value calculations of the cost, we can also see that the net cost comes to $24,200. Then the value estimation is pretty simple. So for the total profit, we basically take the total cost versus the savings. So if we have savings of $33,400, we deduct $24,250, and that gives us $9,150 in total profit. Now, When we look at the cost of capital over the years, we could also do a net present value calculation of the total profit. In this case, the net profit becomes 8,019. And the simple ROI calculation is the net profit over the cost. That gives us a return on investment of 33% for this improvement. Now, often enough, the decision makers will like to know break even and internal rate of return. Break even is basically when we have recovered the cost for the investments that we are doing. In order to do a break-even calculation, we look at the cumulative net savings. In this case, you can see here that the net savings is equal to the net savings up here. And then we are making them cumulative. That means that for year 2018, we add up the 3,000 made in 2017, and then add on the 10,584 made in year 2018. And that gives the amount here of 13,584 and so forth for the rest of them. We do the same thing for the net cost, and that gives us a cumulative cash flow you can see here at the end. Now, in order to estimate the break even, we have to look at where the cumulative cash flow becomes zero. We can see here it is somewhere between 2019 and 2020, and we use a simple interpolation calculation in order to determine that the break-even happens in the middle of February 2020. Another key estimation of value that has been used in a number of different situations for the more advanced business cases or the investment appraisal is the internal rate of return. In order to estimate that, we typically look at the cash flow, the total cash flow. You can see here, we've written them out for the different years, and this is the total one before we do a net present value calculation. Then we look at the present value of the cash flow, and where it becomes zero. So in this case, the internal rate of return is calculated at which rate, with what percentage our present value of cash flow becomes zero. And then in this case, the internal rate of return for this project is 24%. So that is an example of a more advanced financial business case of how to determine whether some initiative is worthwhile conducting or not. Now, if we look at this one, you can see here that the return on investment is 33%. Their internal rate of return is to 24%. So all of these ones have pretty high returns and values. And in this case, it is very likely that this company finds it so attractive that they will implement this solution. So, in short, a business case is an evaluation of the costs and benefits of an initiative and whether the benefits outweigh the cost. Most companies, they are using a financial business case to estimate whether an initiative is good or bad. So they look at the financial benefits, they look at the financial cost, and if the resulting value, for instance, measured in net profit or return on investment, is positive enough, that will mean that the proposal or the initiative gets approved. If the value, so the return on investment, or maybe even the break-even time is too long, then that will mean that the company might not engage in the initiative. Hopefully this has been an interesting little introduction to what a business case is. If you are more interested in knowing more about business cases, we run different kinds of training cases for how to do it. And if you need professional help to make a business case, you're also welcome to contact us. Thanks for listening.